Good morning, everyone, and welcome to Anderson webinar series. Today, very important topic that we are going to discuss and uncover that important topic that is foreign tax credit. I'm sure many of you are aware about that. The UAE corporate tax is applicable on the businesses, which is enriching the income, taxable income in excess of 83,75,000, and this tax is applicable on their worldwide income. And when I say worldwide incomes, various businesses in the UAE has a lot of establishment and permanent establishment outside UAE as well, which means they end up paying the taxes on foreign source income in that foreign jurisdiction. Now, when the UAE tax their income on worldwide income, essentially, that means they will pay the taxes in the UAE as well as in the foreign. Now, that leads to double taxation on the same income that is earned by a business within the UAE, right? Now, this particular double taxation can be avoided within the provisions of corporate tax law through foreign tax credit. And today with me to uncover this important topic is Prateem Sengupta, who is a director and leader of corporate tax in the UAE. So Prateem, tell me something about what is this foreign tax credit? What is included in the foreign tax credit? What is not included in foreign tax credit? Because this topic is a matter of great litigation all around the world. That is what I learned.
Hmm.
So help us and our viewers understand what this foreign tax credit is all about.
So, good morning, everyone. And, I would first thank everyone, for joining this, webinar. And yeah, this topic, I think people have heard these three words, foreign tax credit, but it's important to understand how it works, right? And, let's just start with a simple example. Say, if I'm a UAE company, and like you had mentioned, a lot of UAE companies have subsidiaries or permanent establishment outside UAE. So say you have a subsidiary, outside UAE, a foreign subsidiary, and that foreign subsidiary is paying you dividend. It has earned profits. It has earned profit of, 100. That country, foreign country has say deducted withholding tax of 10, and has paid you 90. Now this 100, you know, may be taxed in UAE. If it is taxed, UAE has some other, what you call participation exemption where this may not be paid. But assuming this is taxed, then would you get a credit of this 10 withholding that you've paid in the foreign country? Simple answer is if it is taxed in UAE, this 100, you would get the credit of this 10, but only up to 9, because 9 would be effective the tax rate in UAE. But there also, there is a bit of complications that can come because a business that pays tax in UAE pays on net income. So ultimately, you will not be only offering 100, you will offer 100 less some expenditure, and you say, and you will pay on the net income. So effectively, it may not be 9, it might be only 6 or 7. So, you'll only get credit for that 6 or 7. So this is how it works. Now, what is critical is what kind of tax you are paying outside UAE, right? And you said that will you get credit for all the taxes? So it's very important to understand whether the tax you're paying outside UAE is a tax of similar nature to corporate tax or not. So
Okay.
that's very, very critical, and it needs to be seen whether that is, to analyze country by country. Something like VAT you cannot claim, but something similar to corporate tax you can claim.
Maybe wealth tax that is paid out there.
When it comes to, you have to see. So they've specifically clarified that something like a zakat in KSA would be considered to be a tax similar to corporate tax, even though zakat is applicable on net assets or income or both,
Hmm.
So it's a complicated, but then you have to make some adjustments to get that credit. That can get complicated, but this is something that you can get.
Very, very important. I mean, often when I visit a lot of businesses out here,
Yeah.
we're doing a lot of impact assessment. So when you go out there and discuss, the impact for the corporate tax, one critical question surface out there. Okay, look, you can get the foreign tax credit. That's
Yeah.
fine. But will I get the deduction of losses?
Oh, yeah.
Right. So often these kind of question comes in. So my key question to you is that can my FTC
Hmm.
exceeds my tax due?
No, it can't. Like I had mentioned in that example, it can only be up to 9% or the effective tax rate. One critical part is if you're in losses, like you had mentioned, overall in UAE, then you can't get any foreign tax credit. So if you're in net loss position, even though you've paid tax on some foreign source, you may not be able to get credit.
Okay, so what is the mechanism for this calculation of this foreign tax
Uh,
credit?
like I give you a simple example, but I think it's better to show it through an illustration.
Yeah.
So let's just see the first illustration. I think it'll be important for the audience to go through this illustration. So, when we have, if the is, if you can see the first table in the illustration, there is, a UAE sourced income, say of, 3 million.
Mhm.
Okay. And the interest earned, say you have an interest, you've given a loan to your subsidiary in country X, and you earn an interest of 1 million. So your total income is 4 million for in UAE. Now on this 1 million, you have, say, paid a foreign tax of USD 2725. Okay, USD. Now, while claiming foreign tax, you are supposed to, if we move on, you're supposed to convert this USD into AED.
Okay.
Okay, first. So if you paid your foreign tax in a foreign currency, you're supposed to first convert to dirhams,
Mhm.
AED. And what do? You convert it at the spot rate um, at that point in time, or a monthly rate if you don't have the spot rate. So you have to convert this, and these rates should be published by Central Bank of the UAE.
Yeah, which
So
most of businesses are aware about.
yeah, exactly. So after conversion, say on that 1 million dirham interest income, there was a withholding of 10,000 dirham. Now let's look at how this calculation works. Let's move on to the table below. There's a second table. So like I mentioned that there's a taxable income of 4 million. Now, this corporate tax, right? 4 million, we all know, like you had mentioned initially, right? That, there is a threshold of 375,000. So say 4 million less 375,000, then you apply 9% on that. That amount comes to 326250, right? Now, how do I, now this is my tax payable in UAE on
Mhm.
the entire 4 million, 326,250. Now I have paid 10,000 dirhams as foreign tax. Will I get the entire 10,000 or will I not? This is a complex calculation where I'll tell you. So it has to be lower of 10,000 or the proportionate amount which the foreign income makes your total income. What I mean is that I said 1 million out of 4 million is foreign sourced.
Mhm.
So you divide 1 million by 4 million and you multiply that into 326250, your UAE tax payable.
Okay.
Okay, so you get the proportionate
Proportionate.
amount of your tax. So you have your UAE tax. What is the proportion of that UAE tax to your foreign sourced income?
Mhm.
Okay,
Mhm.
1 million by 4 million into 326250. That, if audience can see the example, comes to not a round figure, but something like 81,000 approx dirhams. Now you have 10,000, which is the actual withholding, and
Mhm.
then you have 81,000, approximately 81,000 dirhams. You can only get the lower of the two. Okay.
So you get 10,000.
You get 10,000, which is the actual withholding.
Mhm.
10,000 less 326,250 is 316,250. But if we move on, if we change the example, let's go to the bottom part of the table. Okay. Now, assuming this withholding wasn't 10,000, assuming this withholding was, say, 100,000.
Mhm.
Okay. Now you have to compare 100,000 with 81,563. So we did that calculation, 1 million by 4 million into, what you call 326250. That came to 81,563. Now you have to compare 100,000 with 81,563. Now your actual withholding is 100,000, but you'll only get for 81,563. The remaining part, which is some 18,000 approx, 18,005 some 400 something approx, would be your unutilized foreign tax credit. Okay. Now, unutilized foreign tax credit you can't carry forward.
You cannot carry forward,
Yeah.
which means it's gonna lapse in a year.
Yes.
Wow, that's interesting. So
Same here. It lapses. So it's not. It's unlike a loss, right? It's unlike your losses which you can carry forward set off. You cannot carry forward unutilized foreign tax credit.
wow, that's very interesting. I mean, that brings to very important factor that when people do the businesses out there,
Yeah.
they're not necessarily just think about taxes, but they also need to talk about and think through. is a contribution of the foreign source income versus the income which is generated UAE
Exactly.
source, right?
Exactly.
So that mechanism is very important, and that mathematics need to be done should you wanted to take 100%
Yeah.
credit against withholding tax.
Exactly. And like I said, it's, people will tell you up to 9%, but it's actually 9% on your net income. So that is critical. So you may not get full 9%. And if your withholding is above, say, that effective tax rate, say 10%, 11%, 12%, you will not get full credit. You will only get proportionate credit, and the difference you might have to forfeit. Yeah.
Okay. I think there are further complications to
Yeah.
this. I mean, let me just think about another key question that every member and audience wanted to know about, that what if this foreign source income is not taxable in UAE?
Ah, okay.
Okay.
Yeah.
So what if this income is not taxable in the UAE? Still you pay withholding in the foreign jurisdiction. Let's say Europe, you pay the tax,
Yeah.
but that income is exempt in the UAE.
Yeah.
What happens in that scenario?
Here it is very, so this is the way UAE has drafted its foreign tax rate. We call this an ordinary credit method in the tax world, where in ordinary credit method, what you have is you don't get a foreign tax credit on an income which is exempt in your resident country. So when your company in UAE, your residence is UAE. You're a resident company of UAE, and your source country would be a foreign country. So
Mhm.
whenever that foreign sourced income is exempt in your resident country, and you will not get credit of that. So even though, like I'd given the first example, if you recall at the beginning, say dividend, right? Dividend has participation exemption benefits in UAE. So a lot of subsidiaries, you might meet that 5% criteria. And but when they give you dividend in UAE, if you meet those conditions, dividend is not taxed in UAE. So even though if there's withholding in that foreign country, you will not get foreign tax credit on that dividend.
That's very interesting point, and that
Yeah.
brings out like a lot of businesses coming out in UAE.
Yeah.
They have a lot of investment income outside,
Yeah.
which may be subject to withholding or maybe the corp tax out there
Yeah.
in different jurisdiction. Now, when they bring out that money, that may not necessarily mean that they'll be available for foreign tax credit.
Yeah. The logic is basically foreign tax credit is a mechanism to, you know, address the issue of double taxation. So when your income is being taxed in one country and not in the other country, then you don't have a situation of double tax. There's only one country taxing your income. So that is the logic behind that.
Perfect. I think that set the context for the next point, which we talk about the. You mentioned repeatedly that foreign tax credit get paid,
Yeah.
right? So when we say about getting paid, what do you mean by paid? And considering the jurisdiction, when we talk about multi-jurisdictional businesses out there,
Yeah.
there may be differences in term of their financial year. There may
Yeah.
be difference maybe in the accounting year. There may be difference in term of
Yeah.
their policies.
Yeah.
So how these timing differences are being dealt into.
Very interesting. I think that way UAE, came out with a recent guide on foreign sourced income and foreign tax credit. And I would say that UAE has adopted a very progressive, at least rules on this. So assuming that your subsidiary or your subsidiary or your foreign presence has say has a financial year of April to March,
Mhm.
right? And you are Jan to December. And there's a timing difference, obviously, in the financial years now. But what UAE is saying is that whenever this foreign sourced income accrues to you, so regardless of which financial year you are, the foreign company is following, whenever that income accrues, so whenever you recognize that income in your books of accounts in UAE, that is when you claim foreign tax credit. Now, this is regardless. So we mentioned paid, right? Paid does not only cover, say, actually paid. So they have said that it will also cover taxes accrued in the foreign country. So if the company has declared say dividend in, assuming like we are approaching 2024, right? Has declared dividend in April 2024. Okay.
Mhm.
Now this dividend has been recognized in your books of accounts in UAE in 2024. but the foreign country has paid taxes on this dividend declaration only in 2025,
Hmm.
as per their laws, when they have actually, distributed the dividend to you into your bank account.
Correct.
2025. But in UAE, you, because you have declared this income in 2024, even though the taxes are paid next year, you will claim foreign tax credit based on the tax rate in the foreign country. So whenever you offer the income, you pay. It's
Okay.
very
So
interesting.
this is very interesting. Like often we like,
Yeah,
I mean, I say that non-corporate tax professional,
yeah,
they always have this concept in their mind
yeah,
that how the UAE government will gonna take that
yeah,
money out from the the foreign tax authorities,
yeah,
how the settlement actually works.
yeah. So you'll have to, look at, whether you've actually paid or not. So sometimes what happens is that when you take, so one of the drawbacks of that is when you're taking credit on an accrual method, right? Sometimes you may not pay that amount.
Okay.
Okay, actually, in the next year, say they've defaulted on the payment,
Hmm.
they've actually not paid it, then you have to see, then you have to make a voluntary disclosure in UAE, or you have to revise your, or you have to mm, lower your claim in that year's return, or you change the return for next year.
Which means what you're trying to say that is that if you actually didn't pay the tax,
Yeah,
you need to return the credit that you have availed now.
exactly,
Oh, that's very
exactly.
interesting. So this is not ending in just like when you claim the credit, it's not over there.
No.
It's over when you actually get paid the situation
And
out
the
there.
tax have to be certain as well, Anurag. So, say tomorrow, if they go through a litigation in the foreign country and they dispute one tax, you cannot claim tax rate of disputed tax
All right.
until that litigation ends. So, it has to be a certain tax payment.
And then there'll be time limit. Is there any time limit in the UAE that you can claim the foreign tax against a foreign source income up to a certain number of years?
No, so it has to be only like I mentioned, whenever you're offering that income to your UAE income tax, that is when you claim. If you've missed that, you've missed that permanently.
Okay.
So if that income has accrued to you in 2024 and you've missed claiming the tax credit in 2024, you can't claim it in 2025.
Wow, that's pretty interesting. So
So
this area is very
yeah,
relevant and a very important area.
yeah,
Should your foreign tax is there
yeah,
significantly? Now that brings to another point out there. If I have multi-source foreign income out there,
yeah.
how that is being calculated?
Very interesting. UAE again follows a income by income approach. I think it's time to look at another illustrations for this,
Mhm.
where we can go to the second illustration where we've given an example. Say you have UAE sourced income of 200,000 and you have interest from country X of 100,000 and you have royalty from country Y 500,000. So 200,000, 100,000, 500,000. 800,000 is your entire income,
Income.
total income in UAE. On 100,000 interest, you have paid a withholding tax. So country X has withheld 1,000 and country Y on royalty has withheld 50,000 on 500,000.
Hmm.
Okay.
Yeah.
Assuming 10% on royalty, 1% on interest. 1% is very low. Very honestly, practically, the interest is always usually 10%.
Yeah.
But just for an example, now when I go to, calculate, let's look at the table below. When I look at when I calculate my total income, I have 800,000. Now, remember, I had said in the previous example, foreign source income 100,000 by 400,000.
Correct.
You have to now do this income by income. Now you have 100,000 interest. How much did you pay withholding on 100,000? 1,000.
1,000.
Now you compare 1,000 with, you now divide 100,000 by 800,000 into the tax payable on your UAE tax. Okay. So 100,000 by 800,000 because your interest is 100,000 by 800,000 and into, whatever the your tax payable, which is in this example, 38,250.
Yeah.
So you have to see income by income.
Income.
So this comes to around some 4,700 dirhams. 1,000 versus 4,000 lower, you only
You
get
claim.
1,000.
Mm.
Now you go to royalty. Royalty, the withholding was 50,000. Okay. Now you have to then divide 500,000 by 800,000 into 38,250. That comes to 23,000. Now this amount, 20,000, approximately 20,000, is lower than 50,000
Yeah.
effectively.
Yeah. So this is what you're gonna get the credit.
Only 23,000. So you have unutilized tax credit of again around 26,000 dirhams approximately, which you cannot get credit of. So you have to go income by income. So some income you might get entire credit of withholding, some income you might not get the full credit because that withholding tax rate may be more than your effective tax rate in UAE.
And I think that will be very interesting to see in case of zakat, because a lot of UAE businesses have establishment out of Kingdom of Saudi Arabia,
Yeah.
and that's where you pay corporate tax, which is like 20%,
Yeah.
right? So and obviously withholdings as well. Should you not get multiple certificates of, like, you being a tax resident here, and even doing so, there's a lot of complexities involved with respect to corporate tax and zakat, obviously.
Yeah.
So I think that will be very
It,
interesting to see that how this entire calculation people gonna see.
for sure. I think that is zakat is going to be a complex process in order to get your credit because you have to recompute as well. Yeah.
So another point when we talk about double taxation. So I think UAE has over 127 double taxation agreements
Yeah.
with different countries out there, and these double taxation agreements talks about tax avoidance.
Yeah.
So how these agreements are helpful in context of foreign tax credit?
It is very, very important in foreign tax credit. Basically, UAE corporate tax law says that your tax treaties and double taxation avoidance agreements would overrule your UAE corporate tax law wherever there's inconsistency. And the UAE FTA has also clarified that if there is another method to get a tax credit in the tax treaty, then you apply the other method. And if I'll ask the audience to recall that initially what I had mentioned was UAE has adopted an ordinary credit method. Now, treaties, depending on which treaty you are, could provide different methods. So
Hmm.
there are 4, 5 different methods here, Anurag. So you have to look at from which country you're getting the income. So there's something called full credit method where you can get credit on exempt income.
Wow,
Yeah.
that's awesome.
Then there is tax pairing relief where even if your income is, is exempt in the source country, in the foreign country, you can assume that it has been taxed and you can get credit of a tax which you've actually not paid ever in the foreign country.
Wow.
So, and then there is underlying tax rate where you can get, where Singapore has this, usually with their country, with their other countries where you assume that dividend, when you pay dividend you pay on profits, so you assume that you can assume that the entire profit has been taxed and there's been no exemption on dividend. So you have different methods, so which treaty you are, which method you follow, you can get you know uh, uh, credit.
But Prateem, tell me, I mean, practically you have over 13 years of experience working on
Yeah.
the corporate tax.
Yeah.
What kind of, how this development that you entirely see that, and these methods, I say that who's now going to experience tax in across their businesses, they might not have heard about
Yeah.
these methods, because I mean, treaties
Yeah.
for the UAE businesses are very new things. I mean, taxes is very new, so they start
Yeah.
reading about taxes now. How do you advise them to go and read about more on these lines? So what actually should they do?
I think they definitely need help, assistance from any, they need to first identify which country this income is coming from,
Hmm.
look at the treaty, look at the methods, and properly do a forecast of how much income they plan to get
Okay.
in the next year. See what the UE tax payable is, do a calculation, in-depth calculation as per the method in the treaty. If there's no treaty, then you have to follow UAE corporate tax law. If there's a treaty, you have to follow the mechanism in a treaty. But then they will get an actual forecast of how much the tax payable would be. Because without that, just applying a 9% on taxable income will not work. Very
So,
honest.
so you mean to say that there's a lot of planning that you need to do at
Of
the
course.
beginning of the year,
Yeah.
essentially, because if you do towards the end, probably you may miss certain aspect of the thing. So you need to look into the provisions of the law, then you need to compare it along with treaty,
Yeah.
and then you need to plan a robust documentation kind of stuff.
Yeah, so it's documentation is very critical. I think we can look at this. We have a slide as to what documentations are required. At the what you call at the time of getting the credit, and UAE FTA has clarified that your documentation should show the amount. You should have documentation to support if it's in foreign currency, the exchange rate applied, the spot rate. You need to have that evidence, the nature of the foreign tax, whether it's corporate tax outside UAE or is it zakat. So
Hmm.
what nature, the date at which you've paid this corporate tax. So again, it's very critical which year you can claim the foreign tax, right? And some of the important documents, audience can see in the right. What are those documents? So one thing, from my experience in other jurisdictions, right? It's very, very critical to have the receipt. So whenever you pay taxes, you should have a receipt of that tax, which will give you date of when you paid, the amount of foreign tax you paid, and along with the receipt, you should also have your income tax return that you file for that foreign company outside, so you can clearly show
Sure.
what income has been offered to tax and what is the amount that you have paid. And also, if there's withholding, every government gives a withholding tax certificate. Yeah.
Okay.
And also, if the country, so if the documents are not in Arabic or English, you need to get that translated,
In English,
or Arabic.
Arabic,
Well, yeah.
which is very, very important. I think UAE has a lot of businesses which
Yeah.
is operating in multi-jurisdictional, which is in Europe, United States, Middle Eastern countries,
Yeah.
Asia. So I believe from an authority perspective, these document will definitely help. So before we conclude
Yeah.
on this particular matter, I would like to say that to our viewers that foreign tax credit is a very important and integral part of the corporate tax. And what is I learned today in this discussion out there is that a very structured planning at the beginning of the year, comparing various provisions into treaties and the law, while you also anticipating what the income is going to be throughout the year, at the end, how much income that you're going to make. So that projection is very essential for availing a significant or majority of foreign tax as a
Yeah.
credit in the UAE.
Yeah. Exactly.
Any final remark, Prateem, before we?
No, I think businesses should act quickly, should identify the foreign sourced income and forecasted foreign source income. And like you mentioned, this should be done, sooner rather than later. So everyone's trying to find the effective tax rate, right? All businesses,
Yeah,
but without fully, accounting for, or keeping, some time, like at least some computation out for foreign tax credit, you'll never have the effective tax rate that you're going to get.
perfect. I think
Yeah.
that sets out the
Yeah.
context. I would like to thank each one of you to participate in our webinar today. Should you have any specific question, do feel free to write to us on our any of the platform, which is LinkedIn, Twitter, or YouTube, or directly email to us at info@ae.anderson.com, and we'll try to answer your questions as soon as possible. Looking forward to interact with you for more important topics on tax. Stay tuned. Thank you so much.
Thank you.